Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Happy Monday. Hope your week is off to a good start. Taking a look at another consumer staple. These are being punished quite a bit as rates rise. PepsiCo down about 14% in the past year, but really flat or close to flat in the past 5 years. So a 1% return plus your 3.5% dividend. Your annual return here in the past 5 years, not great if you're a Pepsi investor. The performance in the long run is better, but not all that much better. So what's going on? Again, you look at the performance here, starting to slide towards the mid to latter part of 2024. October 2024 in particular. What happened since then? Well, the risk-free rate has started to come up in a big way since then, up about 100 basis points since the latter part of September. Those are often compared against each other. You get a risk-free 4.5 to 5%, depending on the length of your bond, versus, in October, a 3% yield on PepsiCo, now closer to 4%, which makes more sense as an investor. Maybe people are starting to trade off these consumer staples that are losing their revenue boost that they got during the pandemic and are now growing close to zero or even shrinking in certain scenarios and moving into treasury bonds. Time will tell, but end of day, PepsiCo is probably a bit overvalued in the 180s here from a free cash flow yield perspective, especially compared against a risk-free rate, and now is getting more fairly valued. PepsiCo makes drinks, convenience type foods, chips, etc. Kind of similar to, Coke, Keurig, Dr. Pepper, etc. Obviously, Coke is more focused on the drinks, better margins on the Coke side, but now PepsiCo has a larger business inclusive of all of these other brands that they have. Probably some upside, some acquisitions that they make here. They acquired Siete Foods not too long ago. They acquired full ownership of Sabra, which makes dips. Siete Foods is kind of in the health food space. They make gluten-free, dairy-free chips and dips and tortillas and stuff like that, made out of almond flour and cassava flour and stuff like that. So obviously, PepsiCo focused more on the healthy food side of the business. They see that as the future growth area, but growth is not what they're seeing in the last year or so. Year to date, revenue is up about 1%. Big dip on Quaker Foods, mainly driven by a recall they had, but volume down 2% on convenience foods, down 1% on beverages. So really pushing through that revenue growth after about 3% increases in prices. That's not amazing to see from a consumer perspective. That's maybe going to catch up to them in the future. But end of day, growth is slowing, and that's why the stock is down, as well as the risk-free rate being up. Operating profit still positive, though, 4% growth on a GAAP basis. Obviously, some negative impacts here in terms of foreign exchange and this recall they had from Quaker Foods, but end of day, it's at 4% on a reportable basis. And then guidance they gave for 2024, down from about 4% revenue growth for 2024 to a low single-digit increase in organic revenue. And then EPS still growing, so margins are improving despite the fact that their revenue is kind of coming down to a halt. What's improving on the margin side? Well, their price inputs are coming down. Sugar was up quite a bit from the lows of the pandemic to about $28 a pound just last year, down to the $18 range as of today. So that's a positive for them. They obviously had some inflation on the wage side. All inputs were up quite a bit during 23, 24, and now are starting to come down. So margins are improving, which is why they can grow their EPS despite their revenue being flat. They also had some layoffs, closures of some plants, kind of consolidating some of their bottling operations and all of that good stuff. But as you look at Pepsi, again, valuation is important here. You sort of saw their free cash flow yield and their price intersect in the last couple of years as the revenue growth during the pandemic showed some positives. You saw 21 up about 12%, 22 up about 8.7%, 23 up about 5.9%. And maybe the market thought that was going to continue. Hey, we're going to see mid to high single digit growth from a company that historically has basically grown at 0 to 2 to 3%. Probably an unlikely expectation, which is why the stock is being repriced back to where it historically has been priced. You kind of saw during the 2020-21 rally they had, this stock was down into that 2 to 3% free cash flow yield, was trading as low as 2.5% during the highs of 2023. And now that the price has come down, that margins are improving, that free cash flow yield is getting back up into the low to mid 5% range, kind of where it's historically been. If you're historically buying this company prior to the pandemic, you're probably buying it at a 5.5% free cash flow yield. And if you look at their long-term performance, if you're buying it at that level, you're probably getting a 4% return prior to dividends, maybe closer to 7 to 8% after dividends, even going all the way back to prior to 2008. You're getting a 5% return prior to dividends, closer to 8% after dividends. So it's not like a smoke show at that level, but it's still, a consistent high single-digit return after dividends. And it's a company that's pretty consistent in their performance. If you go back to their estimates here, what happened during the pandemic where a lot of companies were seeing a revenue dip, they actually grew. They generated positive net income. They generated positive free cash flow. That's why people like companies like PepsiCo. They are safer because they're going to continue growing or maintaining their revenue even during tougher times. You go back to the recession of 2008, revenue growth was flat for 2009. Positive net income, positive free cash flow. Grew a lot in 2010 and 2011, but that's because they acquired their bottling operations then. So that was part of the growth there. It wasn't really natural growth that they saw. However, people like PepsiCo and companies like it, because if they look at this and they look at a recession or the fear of a recession coming up in the next couple of years, they say to themselves, well, PepsiCo will be safe. And that's true from a revenue perspective. However, if you look at their price, they are still impacted negatively by a recession, even if their revenue doesn't shrink, even if their net income continues to grow. During the 2008 recession, the stock went from a high of 74 down into the 50s. So that's, a 35% drop. In 2020, they went from the 130, 140 range into the, I believe, like 120 range, like so basically 145-ish down to 120-ish, which is another 20-25% drop. So this will be impacted by a recession, however, not as much as some growth companies. Again, if it's a big recession, the S&P 500 might drop about 50%, whereas the PepsiCo and companies like it will drop in the 25 to 30% range. Still negative, but not as bad, I suppose. And that's why people like PepsiCo more so than other stocks. However, because of that safety, you give up long-term performance. Again, a 7 to 8% return isn't bad if you're buying at, reasonable valuations, but it's trailing the S&P 500. You would have been better off just owning the S&P 500, all the tech companies that are there in the last decade, than owning a company like Pepsi. And that's something to keep in mind. If you are, however, a dividend investor, this is seemingly a good time to buy it. You look at, the last 10 to 15 years of data that we have here. It's basically trading at a 3.89% dividend yield, close to the all-time highs for a company like PepsiCo. And this is a company that does grow their dividends, so keep that in mind. Overall, PepsiCo is sort of a consistent performer that is going to drop quite a bit. The reason it's down is because people are comparing it against a risk-free rate that's now close to 5% and a dividend yield here that, is less than that, with the downside of potentially dropping 20 to 30% more than it's trading at today if a recession were to happen. So there's a risk analysis that investors are doing, and potentially if they're worried about a recession, if they're worried about inflation being consistent and rates being high, that's the trade that's happening here. People are moving away from growth stocks for now, moving away from some of these dividend pairs for now, and into risk-free rates that are continuing to rise in the last month or two. And disclaimer, as we look at valuation here, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence, friends. If you want to play around with this spreadsheet, it'll be in the link down below. Hit file, make a copy to use it. As far as valuations go here, you're essentially getting a 4% yield on a trailing 12-month basis, 5 to 5.5% yield depending on the free cash flow margin you're using for 24. I'm using about 11%. The analysts are estimating 11.6%. I'm a bit more conservative, as is my way. Revenue growth of about 0% in the next year, 3% after that. Again, they have some of those acquisitions that are going to start flowing through, and I think they can get back to 2 to 3% growth, kind of stabilize volume, raise prices around inflation, 2 to 3%, etc., and start improving margins, starting at 11% all the way up to 11.6% in 2028. This is closer to kind of their pre-pandemic historical highs, which is maybe optimistic, but if you look at their competitors, you've got Coca-Cola in the high teens, low 20s. So I think there's some upside from where they've historically been. Again, they're consolidating some of their bottling operations, having some layoffs, et cetera. That should improve margins, as unfortunate as that is. They do pay a dividend. They've raised it in that 7% range in the last couple of years. I'm kind of growing it at 5%, so some conservatism there. And the rest of their free cash flow, 75 to 80% of their free cash flow goes towards that dividend payments. Some of that excess is used to acquire other companies like Siete, and some of it is used to do some buybacks. They haven't made significant buybacks in that 1 to 2 billion a year range in the last couple of years, so I'm putting 15% of their free cash flow towards buybacks. They can certainly up that pace if their valuation gets a bit more attractive, but they haven't been doing that in the last couple of years, which again makes sense because their valuation was a bit frothy. So as I look at future valuations, I think 5% probably makes sense. They're going to be in that 4 to 6% range here from a free cash flow yield perspective on a total return basis at today's price of $142 prior to the market opening. Gets me to an expected return of about 8.4%. Again, that kind of makes sense to me. If you look at their historical valuation being in that 5 to 5.5% free cash flow yield range, that's the norm. That's where it's returned, that 4 to 5% pre-dividend yield return. Add the dividend to it, you sort of get to that 8.4%. Just the simple math in my head seems to check out for a company like this one. Again, this is a relatively simple analysis to do. Pepsi is a company you can easily understand. Their free cash flows are relatively consistent, as is their revenue growth. This kind of got away from them here on the revenue growth side. They're sort of going to get back to the norms. If there's some upside here, certainly some upside from this analysis. And the reverse obviously is true as well. So as I look at the free cash flow yield at 5%, I get about a fair value of $127 if I'm aiming for a return that's close to or market beating. So that's a 7% target return prior to dividends, about a 11.8% return, 10.8% return, after dividends. 7% plus 3.8%. That kind of gets you to 10.8%. So if I put a 127 in here, sort of gets me close to 11% or so total return. So it depends on what sort of investment return you're looking for. Right now, obviously, you can get a 5% or close to it risk-free rate yield from a bond versus a 5.5% free cash flow yield from a company like Pepsi. Obviously, Pepsi has some upside. Is the risk of that upside worth it for you in order to risk the potential downsides that comes with owning the stock? That's the answer that's the question you have to answer for yourself in the back of your mind. To me, it's getting there. I think Pepsi's safe enough that I'm feeling okay about the risk difference not being that huge, the equity premium not being that huge. If this starts trading closer to 6%, which would be, maybe 15% below where it is today on a conservative free cash flow yield for 2024, I think that's becoming very, very attractive. But even at, a 10% reduction from today's prices, an expected return close to 11%, that starts to become very attractive because you're going to be in a range here. With Pepsi, it trades in that 4 to 6% range. So at today's prices, you're looking at a 5 to 12% return. That's sort of the range you're at. Obviously, there's downside from there, which is why you want an equity risk premium from a risk-free rate bond. At 27, you're getting into that 7 to 15% range, which is when it starts getting a bit more interesting, which is when I'd be entering a stock like Pepsi. And again, this wouldn't be for my own investments. I'm not really a huge dividend investor. I do have some dividend stocks. I made a video about a dividend portfolio that I started a couple of months ago that's still continuing to get money every single week and obviously is getting more value for every dollar right now as the stock prices drop. However, this would be a stock I'd be interested in for some portfolios like I manage, like some of my, uncles and aunts or some of my parents' portfolios that depend more on dividend payments, that want the income right now, that are fine paying the taxes right now because they have no other income. For me, I don't really want dividends right now. I want growth over dividends, and this doesn't give me that at today's prices. If it suddenly started to trade at, $110, would I buy it for my own portfolio? Yeah, probably, because then the growth would be really interesting despite the dividend. Right now, the growth is somewhat interesting, but you are very dependent on a taxable dividend to get there. But if it keeps dropping a bit more, 127, maybe even like 131 range is when it starts getting interesting from a total return perspective. And then if it drops into the low 100s, then it'd be very, very interesting from a total return perspective. And that'd be something that I'd get into for my own portfolios. But, 127, 131, that range, maybe another 7 to 10% below today's prices gets really interesting. Even today's prices are pretty interesting. I would see why people would get this. An 8% return is not too bad in today's environment when you think about where everything is priced. This is starting to get into an interesting spot. Plus, it pays a consistent dividend, is going to raise that dividend. Pepsi isn't going anywhere. Those are my thoughts on the matter. Let me know what you think about Pepsi down below. Are you interested? Are you buying? If you're a holder, are you holding? Are you worried about it going further down? If you want any specific stocks reviewed, let me know in the comments down below. Otherwise, I'll see you in a future video. Thanks for watching, and bye. Like and subscribe and all that stuff. I always forget to say that. Bye again.